Hi everyone, I hope you're all doing well, and today we're going to be talking about Card Factory stock and if it's a good time to go buy or invest in Card Factory. Now, I know a few guys have been asking me about National Express, and I'll have it on the list for next week or the week coming up. I'll try and get a video done at some point about National Express because I know there's the demand out there, and I'll also go check the Marks and Spencer's video because I said whichever one's got the most thumbs up in that video in the comment section, I'll make a video about that stock as well. So if it's not National Express, then I'll do the one from that video as well. So I'll try to do that one and National Express sometime this week. But today we're going to get stuck into Card Factory, and if Card Factory is a good buying opportunity right now, as always, smash that like button, guys, and we'll get stuck into it. So first off, Card Factory, obviously it's greetings cards, wrapping paper, presents. It's on the high street mainly, that's what it's kind of known as. When I thought Card Factory, I instantly thought of the high street, and you guys that know me, know my investing style. I'm not a big fan of companies that are on the high street because of the rising costs, margins being squeezed, the amount of footfall in the high street coming down. Obviously, the kind of high street stocks are the ones that have been affected massively over the last few months because of the COVID-19 and having to shut down. So I'm always a bit more of a fan of companies that are online, or if they're high street company shops, I want to look at like what they're doing online, what's the progress, because that's where a lot of the growth is. So yeah, obviously straight off high street store, it kind of gave me a red flag. So but when I get into the online side of it, there's a couple of positives here. But we'll just go through the fundamentals of the company first, and then I'll talk about some other things that are going on with the company after the fundamentals. So first off is the ticker symbol. The ticker symbol is CARD, CARD. Cool ticker symbol. It was £3.92 back in September 2016, and that was, a decent price really. Now it's dropped all the way down to 50p. So the main reason why we're actually talking about this company is because of the big massive sell-off in this company. £3.92 in 2016, and in 4 years, going down to 50p, that is a big massive drop. And even this year, it's dropped absolutely huge. It's down 71% this year alone as well. So the company has obviously been going down for a while. So we'll have to see why the share price has dropped so much since 2016. But, we're looking at this as a bit of a value play and seeing, is the valuation now too cheap for the company? Is there a chance that we can make money on this stock because it's sold off so much? Now, Simply Wall Street has this company as 70% undervalued. Now, I always say this with Simply Wall Street is that sometimes when it's value stocks and they've sold off, the valuations are a little bit too high in my opinion, and I would say the same for Card Factory. Even though it's, on Simply Wall Street being 70% undervalued, I wouldn't say it's that much undervalued. I'd say it's about 50% undervalued in my opinion. The P ratio is 3, which is extremely cheap. Now, if any of you guys that know your P ratios, when you start talking about a company that is at a P ratio of 3, that's pretty much saying that it's more than likely going to go bankrupt by the end of the year. So we got to take that one as well and see, is this company actually struggling that much that it should be trading at a P ratio of 3? It's very hard, it's not often you see a company at a P ratio of 3. That is an extremely cheap P ratio. So when we look at the growth, we can see that the revenue wise has actually been okay. Like, it's grown steadily. The big problem is when you start digging into the earnings, and when you look at the earnings, it's going to take a while to recover after the COVID-19, and as well as that, the earnings previously have kind of been up and down a little bit. There's definitely been a bit of a struggle to keep that profitability going up, and that's probably why the share price has gone down, even though it's increased revenue. Earnings hasn't been especially that great. Now, when we take a look at the balance sheet isn't anything amazing. We've got about 66% debt to equity ratio, which is okay. The debt is 147 million, which isn't terrible. The big thing that really kind of kills this balance sheet is the amount of cash it has on. It only has about 5 million in cash, and when you compare that to the debt, it is a lot of debt compared to its cash. In my opinion, this company should have something around about a 40 million cash holding right now. So it shows you that they do really need to improve the amount of cash they have on this balance sheet. And depending on how the company's doing, 5 million to see it through its COVID-19, you might have to raise a little bit of cash there to carry on. I know it's asked for rent to be reduced, loans to be delayed when they pay them back, and they put a lot of staff on furlough, but even so, I think they probably still have to get some cash there. When looking at the insiders, there's not been really any insiders buying over the last 3 months. Previously to that, there was some insiders, but not any insiders in the last 3 months, which I'd like to see at these sort of prices, which could be slightly better. And now we're going to get actually on to some of the stuff that's going on with inside the company. So there has been a CEO change. Karen has been outed, who was the CEO, and Paul Moody has stepped in, who has already been on the board previously, and it seems like he's been the brains behind a few of the recent ideas, and he's kind of, looking now and saying, how can I change this company around? And he's been putting a few ideas in place, which we'll talk about in a second. But the change of the CEO, I tend to agree with, because when you look at what the CEO has done, I think she was there, about 5 years, off the top of my head. But she's been there for a while, and when you look at what has happened to the company over the last few years, when she's been the CEO, you've got earnings decline, the share price has declined. So you've got to question the CEO and go, has the CEO done a good job recently? And you'd say no, judging on the reports and what has come out of the company. So in my opinion, that's a pretty good change in management, because there needs to be something done. And looking at what's going on with the company right now, it looks like there is a few things starting to be tweaked inside the company. So the first thing is the partnership with the Reject Shop, which is an Australian company. It has 356 stores, and basically it set up a partnership to sell Card Factory cards in the Reject stores. And I think this is a really good partnership, because obviously you don't have to pay for the overheads with the stores. It has something very general with a lot of supermarkets, but in my opinion, the Card Factory needs to start selling outside of the UK now. There's only so much you can do in the UK, and then you got to push online, you got to push into other countries. And for me, this is a great move to do a partnership with 356 stores with the Reject Shop. You think about the Card Factory has about 1,000 right now of its own. That's increasing the amount of stores it is selling its cards in by a huge amount, and obviously gives it an extra branch outside of the UK. Preferably, if you could set something up very similar with the US, maybe Canada, maybe New Zealand. Those are three identical countries that have a very much big potential for them to move into some sort of partnership over there. Would be fantastic. So this is a great step forward, and I think this could only increase profit, revenue going forward, which is a great move. The next thing is you got the Card Factory Online, which obviously is not making a huge amount of the revenue up at the moment, but over the lockdown, sales have jumped on Card Factory by 302%, which is absolutely fantastic. So if you could carry on pushing its online kind of side of it, and if it makes 302%, and if it can just carry on increasing that, obviously it can't do it every kind of year, increasing 300%, but getting some more online traffic is a great thing. And the other thing is that it's got another online platform called Getting Personal. During the lockdown, that one grew 68%, and I think there's a lot of potential. If they can market Getting Personal right, it will have a lot of potential to carry on growing. I mean, it grew 68% with this lockdown, but I think it's a good thing having another income stream that's branded different to Card Factory, and hopefully if they can carry on pushing that in the right direction, that should show some growth in the long term. So yeah, I think there's a lot of potential with this Getting Personal brand if they can do it right, and that's what I'd like to see, them pushing that online side. Looking at other countries that they can do partnerships with would be absolutely fantastic. So when you look at everything that they're trying to do, and then you look at the valuation, we're talking here about a stock of a P of 3, and it's starting to show some good signs of life. Even though the balance sheet is horrendous and the forecast isn't amazing, you look at the risk to reward here, and it looks okay. There's plenty of other companies where you look at something like an Aston Martin, for example, and you're talking about a company that has to completely turn it around. It's a company that's not making money that you have to turn around. This one, we've got a good starting platform here with a company that is making money, and it's potentially, putting already things in place that are really going to help the company over the next 2 years. So overall, when I look into this company, I see a good change of management. I mean, the balance sheet could be better, but when we look at the Getting Personal platform, the online sales of Card Factory, its new deal with the Reject store, that's going to open it obviously up to another 350 stores, where that will help the earnings and revenue. And we look at the price of the stock. I mean, a P ratio of 3. Look how much it's sold off. This company is very, very cheap. And when you look at what the company could do in the future, it is a profitable company apart from the COVID-19 side of it. It's a profitable company at these really cheap prices. And for me, when I look at this company, I think that this is way too sold off. I think there is a lot of upside from here. In no terms do I think this is a company that I want to hold for a 5-year spectrum. But when I look at this company and I think, should this company be this price or should it be a little bit more? I think it should be a little bit more. I mean, this company for me should be at least a stock that's trading at about £1 a share. While it's down here at 50p, I think it's a very cheap stock at 50p. It should, in my opinion, should be in the pound range for sure. That's a fair valuation, I would say. So, you know, when we look at that, there is a lot of upside from here, and at least a 50% upside at least. So when I look at this one, I think it's a stock that potentially you could hold for 2 years and maybe make somewhere just over 50% on it. So it's a buy in my opinion, and in my opinion, if the stock price kind of goes down anything from here, I already own shares in them, but if they do go down a little bit more from here, I'll probably just add an add into this position, because I think it is at very cheap bargain prices right now. And that's the video today, guys. Talk about Card Factory. Let me know down in the comment section below what you think about Card Factory. If you're a shareholder in Card Factory, what you think this stock should go to. And as always, guys, like the video, subscribe if you haven't, and I'll see you in the next one.